Let's now dive straight into the performance to start with. So let's start with coffee can. So if you look at the performance of coffee can in February, obviously been a difficult month as far as February is concerned. Saving capital seemed to be the objective in the month of February rather than making money. So in this context, the fund was fairly resilient. In fact, if we take a slightly long-term view of about 1 year, there has been a decent alpha as well, which you can clearly see that for the last 1 year, the fund is up almost 4% versus 1% for the Nifty. In terms of the top performers in February, thankfully we had some smiling reasons as well. So about Bajaj Finserv and Interglobe were three stocks which were sort of the top performers. And the bottom performers were mainly your mid caps, which were also a part of coffee can. So Concord, KFIN, which are largely mid caps, and small and mid caps obviously got significantly butchered in the month of Feb. So they were amongst the bottom performers, followed with Trend. Moving on to Good and Clean. So if you look at Good and Clean as well, the fund did fell, but it fell in line with the broader markets. Again, if we take a slightly long-term view, from a 1 year perspective, the fund has shown a strong resilience, and it's again up almost 4% versus flattish as far as the index is concerned. Amongst the top performers, again, there were a few which were in the green. But just to name specifics, Cholamandalam Investment and Finance Company, Aegis Logistics, and Blue Star were amongst the top performers. As far as bottom performers are concerned, it was KEI. So KEI, obviously, everybody knows that Ultratech did announce entry into cables and wires, so it has nothing to do with fundamentals. But obviously, from a sentiment perspective, it was a drag. And the other two bottom were Emphasis and Deepak Nitrite. Coming to emerging giants, which is a small cap portfolio, obviously small caps had a very tough time as far as the month of February is concerned. Here you see BSE 500, and that's why you see significant underperformance. But I think relative to the small cap index, there was some alpha which was generated in the month of February. But obviously, from a regulatory perspective, we are required to show only versus BSE 500. As far as the top performers are concerned, Arvind was flattish. Venus and Alkyl fell by about 4 and 6. So given the carnage in small cap in the month of February, obviously we did not have any stock which was in the green. But obviously the month was such that to fell slightly lower than the broader market, so you would have done a good thing. It was that kind of a month. Amongst the bottom performers were Sonata, Green Panel, and Rajratan. Coming to 10x, if you look at the 1 month performance, again, it's compared to sort of BSE 500. So compared to that, there was some bit of underperformance which has been visible. The top performers were again very similar: Cholamandalam, Aegis, Venus. And amongst the bottom performance, it was Orchid, KEI, as I highlighted earlier as well, and Emphasis. To micro marvels, so this is the most riskiest in terms of asset class, and obviously February was a tough month. Micro marvels, so we did fell by close to about 14 to 15%. In the month of January, we were a bit resilient, but obviously in February, the market did not spare anyone. In terms of the top performers in micro marvels, Pearl Global, Bajaj Healthcare, and Intero were the top performers, but all of them were in the negative. So there was nothing to show in the green given the market mood. In terms of bottom performers were Mac Power, Khadem, and Rajratan. Moving on to the newsletter. So we thought that it's apt to sort of not sort of focus a lot on where will the market turn, because it's very difficult, honestly, to highlight when the markets will turn. People have very different opinions. But what we thought, which we know more about, is that when the market turns, which stocks should turn. So we thought that there is much more clarity on that part rather than on the timing when the market will move. So our entire focus was to highlight sort of themes which ideally can do well when the market turns, rather than to focus more on the timing in terms of when the market turns. So if you look at, if you just go back into history, FY 22 to 24 was a phase when obviously a lot more money was made, and more so in the small cap. In fact, we did do a thing, and what we saw is that almost 60% of the stocks within BSE 500 gave you alpha during FY 22 to 24. What does that mean? It means is that for every 10 stocks in the index, 6 stocks give you returns which was far superior than the index. Generally, this kind of number is not a normal number, because what that means is that any sort of stone you throw, it will turn into gold. And unfortunately, that is not a reality. That generally happens in movies, but obviously reality is very, very different. But it was a sort of a dream kind of a market mood during FY 22 to 24. And if you look at the table on the left-hand side, these were a few of the top performers within the BSE 500. And if you look at the kind of money which was made in some of the top performers, almost every year you were doubling the money. That was the kind of money which you typically made during that phase. If you look at the CAGR over 22 to 24 across a few of these top names, it was as 122%. I'm not talking about absolute return, I'm talking about CAGR, which means that in 2 years you would have sort of quadrupled your money. So that was the kind of mood which we were sitting at. And few of the sectors which made money during this phase included power, infra, metals, crude oil, capital goods, etc., etc. So obviously, as we go more into the webinar, we'll get into more discussions. But these are some of the sectors which generally are not termed as wealth generators, and I'll show you data as we go ahead. Moving on to the next slide. Yeah. So as I highlighted to you that obviously a few of these sectors which did well, we just tried to look at again the same set of stocks, that what would have happened had we invested money in FY 12 and waited till 22 in these names, which actually made money during 22 to 24. So just for a second, if you sort of ignore FY 22 to 24 and just look at the last 10 years, actually you would have lost money. So what we are trying to highlight is that these kind of names which made money in the last 2 years, they actually lost money during the preceding 10 years. So typically what we are trying to highlight is that from an investment perspective, obviously it's very difficult to invest in these names, because I'm sure that as an investor, had you invested in FY12, you would have not been able to wait until FY22 in many of these stocks, because 10-year period, if you lose money, then it becomes very difficult to sort of build an investment case in such kind of names. And if we go on to the next slide, if we continue the debate, what led to such a sort of optimism in many of these names? So if you look at during COVID, obviously the government tried to play a fairly supportive role, because the corporates were sort of fairly cautious in terms of investments, and they were trying to protect their balance sheet. So a lot more focus post-COVID was to sort of repay your debt and ensure that you don't sell goods without any advance. So working capital cycles got tightened, and capex went for a toss, and the money was actually used into repaying of debt. So obviously government stepped up, and we saw almost a 24% CAGR in terms of capex spends by the government post-COVID. And that actually ignited a lot of attention in sectors which were beneficiaries of this disproportionate capex aggression, which was shown by the government. So obviously, if you look at the table, you can see that the kind of money which was made in sectors like cap goods, power, infra, metals was insane. I mean, these sectors obviously went through a significant re-rating, is the term which was highlighted during that time. And that's what ignited the interest, the government capex bit. Moving on. Yeah. So if you look at post-elections, obviously the interest in many of these sectors sort of fizzled out. So if we look at June 3rd till 31st December, in terms of what kind of money was made in these sectors, actually money was lost. Money wasn't made, but money was lost across these sectors. So the same sectors like cap goods, power, infra, metals actually saw a lot of disinterest. And the reasons were very, very simple. So in the general elections, BJP was not able to get a single majority by themselves. So obviously there was a coalition which happened, and resultantly the government focus was more into socialist kind of behavior in terms of spending, and obviously that took precedence over capex. So obviously the rally in such kind of stocks fizzled down, and in fact, if you look at January till March, arguably a large part of wealth which was made during FY22 to 24 has actually got eroded. Had you remained invested even in the months of January, February, March. So it's been a very tough time for those who made money during 22-24 to see through this phase. If we move on. And why this happened? I mean, if you look at the fundamentals of many of these names, so Sahil, if you just take two few slides back where we can show them the fundamentals. One more slide, one more. Yeah. So if you look at the median ROE of many of these names, it is just about 11%. If you look at 10-year earnings growth during that period of FY12 to 22, it is just 3%. If you look at free cash flow yield, it's negative. So what we are trying to highlight, Sahil, if you can move back to the original slide. So what we are trying to highlight is that obviously the money post elections started changing buckets. So they started chasing sectors and stocks which were more based on fundamentals and numbers versus pure play narratives. So obviously, a few of the number-oriented sectors like FMCG, healthcare, financial services, consumer durables, IT, which are more like consistent sectors and which make money every year, started seeing a lot more interest because obviously the liquidity started drying up, and therefore, when liquidity generally dries up, stock selection or sector selection becomes that much more relevant and important because typically, when there is excess liquidity, you typically try to broad base your portfolios because you are not able to invest in the same less number of stocks. You have to, so if any mutual fund is 70, 80 stocks, they'll become 120, 130 because if you keep on getting liquidity, you start spreading out your stocks, and that's where some of the uninvestable stocks also find liquidity, and hence the stock price reaction is that much more sharper. But when the liquidity dries up, it's again back to classic Rahul Dravid style of batting, where typically the technique or the stock selection becomes that much more relevant. And if you can see on the second table, all the Ambit portfolios started delivering post elections until 31st of December. And you can see versus benchmark, there was a significant outperformance, which tells you also that we are more number oriented rather than narrative oriented. Moving on. However, since January, market seems to be in a very different mood. There is a sort of significant pressure as far as stock markets is concerned, and there is more pressure on the small cap and the mid cap names because essentially the liquidity seems to have dried up. So volumes in small mid caps in many of the stocks have become less than one third of what they were, and hence there is very sort of acute price movements. And irrespective of numbers, all kind of stocks have seen a drawdown. Numbers relatively lower compared to sort of narratives. As you can see that the top table, the performance in more narratives, the drawdown has been much sharper. And if you see the bottom table, there is drawdown, but the extent of drawdown is not as sharp. So what we're trying to highlight is that even if you have invested in a very fundamental stock, it has been down. So you need not sort of think a lot on stock selection because all type of stocks have been hammered. So if someone is sort of thinking that why is the stock falling despite the numbers getting delivered, one should not lose their sleep because it's a different type of a market mood where there is a liquidity exit and essentially there are hardly any buyers because everyone is thinking that typically we'll wait for the market to stabilize. Once the market stabilizes and sort of bounces up, say 5-10%, we'll buy after going up 10%. So there's a lot of wait and watch which is happening. A lot of mutual funds are sitting on cash. So I mean, it's a phenomena which you see every 3-5 years, where such kind of correction happens, and people sort of stay in a wait and watch mode. Moving on. So what we're trying to spend more time in this market mayhem is to ensure that the portfolio bounces back when the market mood sort of improves. So obviously what is in our control is to ensure that we pick the stocks which are relevant from a fundamental perspective, and the earnings growth keeps on getting delivered. So if you look at the table on the left-hand side, and if you look at the earnings growth in the third quarter across our portfolios, it's been extremely strong, high double digits. And if you were to compare it with benchmark, then obviously it will look far more superior. So what we are trying to highlight is that your money is parked in very, very fundamentally strong companies. And as and when the market mood bounces back, obviously, as I highlighted earlier, that in a liquidity dry scenario, the liquidity will chase less number of stocks. And our hunch is that sort of it will chase stocks which have high growth, reasonable valuation, and more importantly, stronger balance sheets. So if you look at table on the right hand side, you can see that even in FY26, at all our portfolios, we are looking at very strong earnings growth. And when you compare it to respective benchmarks, the earnings growth is far, far superior. And if you look at the PE, the PEG ratio, and the return on equity and compare it to the respective benchmarks, it looks far, far attractive. So ideally, what we are trying to portray message to our clients is that nobody knows where the bottom is, but try and top up during such times, because it's very rare that the market will correct so much in a 2 month period. And that's where you need to sort of assess your portfolios from a fundamental perspective, because as the market bounces back, so there is a say or a talk in the market that possibly by March end or April, the bottom will be there, because in the first quarter FY26, there is an expectation that the earnings growth will bounce back across various benchmarks. So I mean, when the market bounces back or comes to sanity, obviously the portfolio should shine the benchmarks. And that's where we are trying to spend more time, that to ensure that the health of the portfolio is not bad. And it will not take a lot of time to bounce back as well, because the fall also has been sharp. I know that it will not come back in 2 3 months, but I mean, given the kind of recessionary trends that we are seeing across the US as well, where will the money after all go? Ultimately, markets which will deliver growth with good ROEs will see flows. So to that extent, I mean, there is a lot of negativity, noise around the current market mood. Use that to your advantage, because buyers are very few, sellers are more. And generally, history shows that people who have invested during demon, people who have invested during COVID, have made the most money. So times are in front of you. It's your money, I know, but typically these are the times where if you top up, then typically money gets made. Moving on. I think that was it on the webinar. Over to Trilok for the macro update.
Yeah, hi, good evening. Thanks, Bhargav, for a very insightful, discussion and history from what the market teaches you. So I'm a firm believer that market history never repeat, but it usually rhymes. So obviously these opportunities are such that one should sort of take clearly advantage of. And I concur with the Bhargav's perspective on trying to allocate more capital in conviction names and asset managers. Moving from what we wrote to what's happening around is, we thought it's very important to understand what's happening around the world, particularly with the US, creating a lot of noise, or I would say, creating a lot of sort of news regarding the tariff updates, particularly with respect to other markets. We thought, let's take a step back and evaluate what exactly and which countries are most exposed to in terms of numbers. If you look at the data table out here, clearly reflects that the trade, and the way to read this data is not the net imports in CY24, $320 billion, $319 billion for China is basically a trade deficit for US. So it's effectively the net imports from China to US. The net imports is 463, and the export to China is 144. So effectively, US is running at $319 billion trade deficit with China. And if you look at the last 5-6 years of horizon, the number has actually declined from a China net trade deficit from US. And the largest sort of growth, numbers, if you look at Taiwan, is obviously $75 billion of trade deficit, but the growth at an exponential 27% growth. Vietnam stands, next at 21%, and then subsequently followed by Mexico and Canada. So although from a absolute growth point of view, even India is a 13% CAGR, but the quantum is very, very minuscule at $49 billion. So the idea here to showcase here is, to my mind, even if the tariff imposition happens, they will probably do to the countries where the net trade deficit is the largest, which is China, Mexico, Vietnam, and potentially even European counterparts. More importantly, when you even look at the largest export market for India. So for India, which is obviously a largest export, US remains the largest export market from an absolute quantum, because India do exports roughly 380-390 billion of exports. $50 billion goes to US. Essentially, sorry, $90 billion goes to US. It's effectively, but if you look at from an export as a percentage to US, it's less than 3%. So to my mind, that's not a major number to get worried on. Vietnam is obviously the largest country exposed to US, and in case of any incremental tariff, they would be actually obviously more impacted compared to us on Indian on the market. So we have given a context of percentage of exposure that gives you which country probably will have a higher impact, in case once the dust settles. From moving from this point to subsequently even looking into sectors. So this is again, India specific sort of story or growth. So if you look at the categories itself, right? Again, looking at what the trade surplus of India with the US, or effectively, the trade deficit for the US with India, effectively we read it that way. So machinery, chemicals, and textile are the three largest sectors to my mind, and stones and glass, because stones and glass is particularly the natural stones that we find in the country, which is again a earth mine stone to a lot of extent. So leaving aside that, because it's it has to do some portion with natural mine as well as some portion with productivity and capability. But if you look at machinery and chemicals and textile, all three, to my mind, obviously a capability in terms of what kind of capability from from a absolute chemistry point of view, or from a labor in sort of what kind of labor and skilled labor can the country provide. So Bangladesh, India, and China are the three countries that can essentially provide this kind of labor, skilled labor that can essentially do the job as well as do at scale. So these three sectors, to my mind, will be closely monitored. And to my mind, there is no other alternative to replicate these sectors if, in case assume that, there's a 5-7%, 10% incremental tariff on these. And as I showcased in the previous slide, Bangladesh, for that matter, even Vietnam, or for that matter, China, all of these will be, having some implications on tariff, and not India in isolation. So to our understanding, there is a lot of noise regarding this particular tariff, and to whatever reading incremental development that we have seen, the magnitude of the impact will be lower than what I had earlier envisaged. Because please understand, any tariff imposition by the US to any country, irrespective of India, China, Europe, or for that matter, Japan, will have an equal bearing on a reciprocal tariff that they will do, and B, also the kind of impact on inflation that the imported goods will happen in that country. So yeah, to my understanding and our belief is, it'll be the impact will be far muted than what most people anticipate at the end of this particular realignment of tariff, maybe in a month or 2 months or so from here on. So moving from tariff to what's happening around by the FIs, as you'll appreciate, there's a lot of uncertainty with regards to tariff. There's a lot of question with respect to US interest rate. There's a lot of question with respect to currency movement, and there is obviously some implication with respect to what FI is going to do. So in the last few months, $25 billion nearly, give or take, has sort of moved out from the country by the FII. But one thing we should not forget that as a percentage of overall market cap or as a percentage of total holding, this is not something new. If you look at the history, GFC was 1.5%. In fact, not very far off. November 21 to July 22 was nearly 1.1% when the Russia-Ukraine sort of war happened. And this is in line with the averages in the last many sort of instances that we see through on screen. Also, this is also aggravated the currency depreciation. So $25 billion in a matter of 4 months versus the intensity. If you look at the last in the historical, it was reasonably spread out across many months. Has also some implication on the currency depreciation for the Indian market as well. To our understanding, if you look at the last 1 year, obviously currency, we have slid down by nearly 5% against the dollar. But if you look at from a 2 and 3 year perspective, we still remains among the reasonably, sort of reasonable currency compared to other emerging markets. And from RE, which is real effective exchange rate, India remains, as one of the most undervalued currency after this emerging market depreciation. So to our understanding, this FIS sell-off should not be looked at in isolation, given the historical averages are not very different. And I think given what kind of measures that Indian government and RBI has done, this will obviously only sort of manage effectively as we move forward. From moving from what's happening by the FIS to what's happening domestically, I think so. This is one thing even Bhargav highlighted. The correction is very broad based. So over 85% of the stocks have corrected more than 20% candidate till date. It's a very rare occurrence in the past. I think so, except for COVID time or GFC, or even for that matter in 2013, where the currency, obviously Indian currency sort of decelerated significantly. Even then, the breadth of the market was not so broad based. I think to our mind, obviously DIS invested in the market for some period of time, but our broader perspective is once the tariff related uncertainties behind, India will FI will move back to the country for two reasons. The growth remains very strong, and second, multiples have also corrected. Plus, more importantly, the arbitrage between India and other markets is very large, even after the earning growth moderation by a couple of percentage points for CY 25 and 26. In that context, when we move to next slide, and when we see what are the recent development, which is market completely ignoring. I think so one and the most important factor, which is government has shifted from consumption from capex to some consumption, which is why we saw what kind of incentive in terms of tax that they gave in the budget, which will have some implications beginning April and May 2025, because you will see higher disposable income in the hands of consumers. Second, obviously, there is the first time in the last 4.5 years, RBI had cut rates by 25 basis points. Followed by that rate cut, there's a series of announcements in liquidity measurement. Nearly 60,000 crore already announced in OMOs, and there is further OMO participation apart from USD swaps, which is basically effectively managing the currency volatility. And India being a net importer of a lot of commodities, I think so. Now crude energy basket for the country is at a 3 year low, which is a great news, because not only it helps to manage inflation, but it also manages to obviously save the much important dollar which goes out of the country, particularly in a situation where the emerging market currencies are vulnerable to any USD strengthening. And one of the larger sort of global 60,000 feet view with global investors monitor is USD 10-year has also retreated. So for example, what happened is, before, if you go back to history, before in September 2024, before the election sort of election took place in the US, the US 10-year, or I would say the 10-year GSEC in US was around 4.2 percentage points, and they obviously rallied to nearly 4.8%, which is again an indication that either markets were uncomfortable with the kind of policies that the Trump will bring on table, or they were equally worried on the kind of inflation those tariffs would actually sort of impact the businesses. I think in the last 40 days that the whole rally has retreated, which essentially gives far more pronounced judgment by the market that if the tariff comes over, the inflation impact could be very very sort of stark for the US economy, and subsequently have implications on the interest rate. Plus, also there is the recent economic indicators, whether it's job losses or the wealth job creation, or for that matter, manufacturing index, uh, indicates some softness in the US economy. So, we think these are some constructive developments which has happened in the last few days, which the market is completely ignoring at. For obviously, markets is very in some in instances like these, market tends to ignore the medium to long term developments constructive, and obviously just focus on the near term noise, which is more effectively now currency depreciation, FI selling, as well as the Trump tariff, sort of gaga that's going to happen in emerging markets. So we think, with that, I'll probably move to the valuation aspect of the business. I think this is exactly one of the things I wanted to also highlight. So MSCI India drawdown of, except for the COVID, this is one of the steepest drawdowns in the last few months, if you look at MSCI India compared to other markets. Importantly, this is the valuation premium that we obviously used to enjoy as a country has actually come back to long-term average of 60%. We had obviously went to as high as 90% valuation premium, because of the fact that other markets were not even delivering earning growth. Forget about increasing earning growth. Importantly, what we also have seen is usually the subsequent time frame, whenever this underperformance is greater than 15 percentage points, subsequent next 6 months is fantastic news for MSCI India, or let's say India stands out compared to emerging markets, is what we're trying to show the message out here. And this is exactly what we're thinking in lieu of the correction of multiples, in lieu of a lot of dust sort of settling out, given the fact that there is some certainty or clarity with respect to what kind of tariffs that will come over, and also with respect to some clarity emerging with respect to earning growth that's going to kick in from Q4 and Q1 onwards. We're very confident that going forward, India will stand out compared to other markets, and India will sort of regain its mojo back in the subsequent months to come by. So, moving quickly to the valuations and summarizing on Indian valuations. So after the correction, India is obviously Nifty is now below 10-year averages. So is the case with mean in terms of price to book. But obviously, the way to think about it, where are we in the BSE 500 mid and small caps? So I think BSE small cap and BSE mid cap particularly has corrected now. So they are still at marginal premium compared to long term averages, not a significant discount to long term averages. However, the excess in terms of higher premium is being knocked off by the markets in the last few months to come by. And we think selective opportunities will remain, and one should be very focused on what kind of portfolio they're investing and allocating capital towards, because we think it's a market where stock specific performance and earning growth will drive the alpha creation for the next year.